In this video, we will see how to prepare adjusting entries. Adjusting entries are prepared to ensure that the revenue recognition and expense recognition principles are followed. Adjusting entries are required every time a company prepares financial statements. Every adjusting entry includes one income statement account and one balance sheet account. Adjusting entries are classified as either deferrals or accruals. The two types of deferrals are prepaid expenses and unearned revenues. The two types of accruals are accrued expenses and accrued revenues. Prepaid expenses are expenses paid in cash and recorded as assets before they are used or consumed. Examples of common prepayments are insurance, supplies, advertising, and rent. At each statement date, adjusting entries are made to record the expenses applicable to the current accounting period and to show the remaining amounts in the asset accounts. Unearned revenues are revenues received in cash and recorded as liabilities before services are performed. The adjusting entry for unearned revenues results in a decrease to a liability account and an increase to revenue account. Accrued revenues are revenues for services performed but not yet recorded at the statement date. An adjusting entry for accrued revenues results in an increase to an asset account and an increase to a revenue account. Accrued expenses are expenses incurred but not yet paid or recorded at the statement date. Interest, taxes, utilities, and salaries are common examples of accrued expenses. An adjusting entry for accrued expenses results in an increase to an expense account and an increase to a liability account. Let us now look at an illustration to see how to prepare adjusting entries. The unadjusted trial balance and the additional adjustment data for Madeline Corporation have been provided. We are required to prepare the adjusting entries. The supplies on hand at July 31st total $600. Note that supplies has an ending balance of $4,000. The difference between the balance in the supplies account of $4,000 and the cost of supplies on hand of $600 represents the supplies used during the period. This is an example of prepaid expenses as cash has been paid for an asset before it is used. To record the adjusting entry, supplies expense will be debited for the difference of $3,400 and supplies will be decreased by crediting it for the same amount. Depreciation for the month is $150. Depreciation is the process of allocating the cost of an asset to expense over its useful life. Because an asset is expected to provide service for many years, it is recorded as an asset rather than an expense on the date it is acquired. To follow the expense recognition principle, companies allocate a portion of this cost as an expense during each period of the asset's useful life. This is an example of prepaid expense. To record the depreciation expense account will be debited for $150 and accumulated depreciation for equipment will be credited for the same amount. As of July 31st, services worth $650 related to the previously unearned revenue has been performed. This requires an adjusting entry for unearned revenues. An adjusting entry for unearned revenues is made to record the revenue for services performed during the period and to show the liability that remains at the end of the accounting period. Since services worth $650 has been provided, $650 must be transferred from unearned service revenue. To record this, unearned service revenue will be decreased by debiting it for $650, and service revenue will be increased by crediting it for the same amount. As of July 31st, services performed but unbilled are $350. This is an example of accrued revenue, as services have been performed but not yet recorded. An adjusting entry for accrued revenues records the receivable that exists at the balance sheet date and the revenue for the services performed during the period. To record the adjusting entry for accrued revenues, accounts receivable will be debited for $350 and service revenue will be credited for the same amount. The company has accrued interest expense of $100 at July 31st. Accrued expenses are expenses incurred but not yet paid or recorded at the statement date. Adjustments for accrued expenses is made to record the obligations that exist at the balance sheet date and to recognize the expenses that apply to the current accounting period. To record the adjusting entry for accrued interest expense will be debited for $100 and interest payable will be increased by crediting it for the same amount.